So, I want to start with a bit of a thought experiment today. If you take a person who has, historically really struggled with their finances, and then you take a highly successful multimillionaire and you hand them both $50,000 in cash today, their biological and emotional responses will be like complete opposites.
Oh, absolutely. Yeah, it's a profound paradox, really.
Right, because the person who is struggling feels this overwhelming wave of relief, but the millionaire, surprisingly, feels immediate anxiety.
Which sounds crazy to most of us. I mean, we are conditioned from day one to believe that accumulating a massive pile of cash is the very definition of financial success.
Yeah, the ultimate goal.
Exactly. But when you examine how the truly wealthy operate, their relationship with cash is entirely different. They're practically allergic to it just sitting idle in a checking account.
They really are. And today, we're pulling from some fascinating excerpts from a text called The Alchemy of Assets: Why the Wealthy Avoid Cash.
It's a great read.
It really is. And our mission for this deep dive is to completely reframe how you think about money. We want to dismantle that incredibly common fantasy of just opening up your banking app to see a balance filled with zeros.
Right, the dream we're all sold.
Exactly. And instead, we want to help you understand the hidden underlying mechanics of real wealth. Okay, let's unpack this, because for the vast majority of people, hitting that high bank balance is the ultimate peak of the mountain.
Or totally.
It represents absolute security. It represents freedom from worry.
It feels like you have finally won the game. But the source material makes a really compelling argument that to a wealthy investor, that exact same screen, that same large pile of idle cash represents a massive quantifiable lost opportunity.
A lost opportunity,
Yeah.
which is just like such a different way of looking at it.
It is. And the text actually uses a rather vivid analogy to illustrate why holding cash is viewed so negatively by people who, truly understand capital. I want you to imagine walking into a massive manufacturing plant,
Okay, I'm picturing it.
a company that employs exactly 1,000 people.
All right, a huge industrial factory floor. Got it.
So you walk onto the floor and you look around, and 900 of those employees are just sitting at their desks.
Wait, 900?
900 just staring at the blank walls, doing absolutely nothing. The machines are completely silent. The production line has ground to a halt.
That's a disaster.
Exactly. Because of this, the business is hemorrhaging capital every single hour of the day to keep the lights on and pay the lease, while producing zero output. You would never look at that factory and call it an efficient or well-run company.
You'd fire the floor manager before lunch. You can't run a business paying for overhead while 90% of your workforce is literally asleep at the wheel.
Right, but the text points out that millions of people unknowingly do exactly this with their financial capital.
Oh, wow.
Yeah, they let it sit in a checking or a low-yield savings account month after month, year after year, fully believing that by doing nothing, their financial situation is secure and well-managed.
Okay, wait, let me play devil's advocate here on behalf of anyone listening who lived through the 2008 financial crisis, or even just the regular, brutal market corrections we see every few years.
Sure. Yeah.
For a lot of people, cash in the bank feels like the absolute safest place. The nominal number doesn't go down.
I get that.
It feels like drafting a world-class championship team and making 90% of your star athletes sit on the bench while the game is being played. Sure, they aren't scoring any points for you, but they also aren't risking a career-ending injury out on the field, right? You're protecting your players.
What's fascinating here is how the text addresses that exact psychological barrier, that feeling of safety you just described. It is entirely an illusion.
Really? An illusion?
Yeah, because it's based on looking at a static number on a screen. The reality is that cash has a fatal flaw in its design. It doesn't just fail to grow, it actively decays.
Right, inflation.
Exactly. When you leave it on the bench, as you said, that static bank balance creates a false sense of security. You see $10,000, and a year later, it is still $10,000, so your brain tells you that you survived the year unscathed.
You avoided the injury of a market downturn?
Right. But it's a mirage.
Here's where it gets really interesting because, well, we all know cash loses purchasing power over time. That is just basic economics 101.
Sure.
But what struck me in the source material is how the wealthy weaponize that understanding. If cash is structurally guaranteed to lose value over time, then holding it isn't a neutral position.
No, not at all.
It is an active loss. You aren't just sitting out the game, you are slowly forfeiting.
And that brings us to the actual mechanics of asset pricing and fiat currency.
Mm.
When central banks expand the money supply, all that new capital eventually has to find a home.
Right. It has to go somewhere.
It flows directly into assets, real estate, equities, commodities, private businesses. So while your cash is sitting safely in the bank, the prices of the very things you might want to buy in the future are inflating in response to that expanding money supply.
Wow.
Holding cash means you are completely sitting out that economic expansion. Your purchasing power is just being diluted.
And the source material doesn't just leave this as, like, abstract economic theory either. It walks through this incredible tale of two portfolios to illustrate how this plays out mathematically over a lifetime.
Oh, I love this part.
Yeah, it sets up two people who each receive a sudden windfall of $100,000.
It is a perfect control group experiment to show the long-term mechanics of capital deployment.
Right. So person A takes that entire $100,000, walks into a local bank branch, deposits every single dollar into a standard account, and leaves it completely untouched.
Playing it safe.
Yeah, playing it safe. Now, person B takes a very different route. They keep a strategic emergency fund in the bank, say $20,000, and then they systematically deploy the remaining $80,000 into a diversified portfolio of productive assets.
And if you pull up a financial spreadsheet on day one, their net worths are perfectly identical. They both have $100,000 to their name.
Exactly. But fast forward 10, 20, 30 years, and the mathematical reality of their choices diverges so aggressively.
Because person B's assets begin to generate returns. Depending on the assets, that could be, quarterly dividends from equities, monthly rental income from real estate, or just long-term capital appreciation.
Right. The money starts working.
Yeah. But the key mechanism is that those returns are then automatically reinvested, purchasing even more assets.
Yeah.
This is the engine of compounding. It is the process where the capital you deployed starts acquiring its own capital.
The math behind it is almost ruthless when you map it out over decades. Let's say person B averages a fairly standard historical market return. Through the mechanics of compounding, their wealth is essentially doubling every decade or so, absorbing all the economic growth and productivity happening around them.
While person A is literally just watching their principal evaporate in real terms,
Right.
even if person A utilizes like a high-yield savings account earning a few percentage points of interest, they are fundamentally struggling just to keep pace with long-term inflation and taxation on that interest. Their $100,000 is buying significantly less in the real economy every single year.
It's wild how two financial journeys that start at the exact same starting line, looking perfectly identical, can end up in completely different stratospheres just because one person put their money to work and the other left it in the locker room.
It's a huge divergence.
But that naturally leads to the big question, right? If holding cash is essentially a slow financial bleed, how does someone actually make the shift from a hoarding mentality to an acquiring mentality?
That's the real challenge.
Yeah, because reading about compounding math is one thing, but changing your deep-seated psychological behavior regarding money is entirely different.
If we connect this to the bigger picture, it requires a complete redefinition of what cash actually is. To the wealthy, as the text emphasizes, cash is never the final destination.
Never the destination.
No.
Yeah.
It is merely a temporary parking place. It is a conduit. Money arrives, it waits briefly in the holding area, and then it is assigned a specific job.
And that job is buying cash flow. It's buying productive assets.
Exactly.
The text outlines a few of the classic examples, like owning equity in successful publicly traded businesses, acquiring physical rental properties, or even just investing in broad market index funds.
The defining characteristic of a productive asset is its ability to create value independent of your daily physical labor.
Which is huge.
It is. Think about owning shares in a major national logistics company. While you are at home sleeping, their trucks are still moving freight across the country, their employees are fulfilling orders, and revenue is being generated.
The business produces value not because you are physically on the factory floor working harder.
Right, but because you own a piece of a system that operates autonomously.
I want you to pause and really think about this for a second. Think about how easy it is to fall into the psychological trap of just opening your banking app, staring at a static number on the screen, and feeling a visceral sense of relief or panic based entirely on the size of that pile.
We all do it.
I've done it. We are completely conditioned by society to obsess over the hoard.
But that conditioning trains us to ask the wrong question entirely. Most people look at their app and ask, how much money do I have? Wealthy investors look at their portfolio and ask, where's my money working?
Where is my money working?
Correct.
That is a massive paradigm shift. It completely redefines the goalpost of what financial success looks like,
It forces you to evaluate the efficiency of your capital. It shifts the entire focus of your financial life from saving principal to producing cash flow.
which are two very different things.
Exactly. Money sitting still versus money producing value are two fundamentally opposed financial philosophies. One requires your constant labor to maintain, while the other scales beyond your personal time limits.
Okay, but I have to push back again because we really have to talk about risk.
Let's do it.
If buying assets is the big secret to wealth, the immediate, glaring, logical hurdle for anyone listening is the very real fear of losing their hard-earned capital. Isn't putting your money into the equities market or a real estate venture just a socially acceptable form of gambling?
I hear that all the time.
Right, because businesses fail all the time. Markets experience massive, gut-wrenching drawdowns where portfolios lose 20 or 30% of their value in a matter of weeks.
They absolutely do, and that is a crucial point that the source material does not shy away from. Investing is inherently uncertain.
Right.
Markets will correct, sometimes violently. Individual companies will go bankrupt. But that exact uncertainty is precisely why experienced, wealthy investors do not concentrate their capital into a single point of failure.
Diversification.
Yes, they use diversification as a shield against catastrophic loss.
So they aren't just walking into a casino, putting all their chips on black and spinning the roulette wheel.
Far from it. They act as financial architects, building resilient systems designed to survive for decades.
That makes a lot of sense.
When you diversify across various productive assets, different sectors of the economy, different asset classes, different geographies, the inevitable failure of one investment is insulated by the success of others. You aren't gambling on a single outcome. You are systematically betting on the long-term upward trajectory of human productivity and economic expansion.
And this connects to a really interesting misconception highlighted in the text. There is this pervasive myth in popular culture that wealthy people got that way simply because they are extreme penny pinchers.
Oh, yes.
We all know the trope, right? The billionaire who clips grocery coupons or refuses to buy a daily coffee.
The myth of extreme frugality as the sole driver of wealth creation, it's a very common misunderstanding that confuses the symptom with the cause.
Yes. But the text reveals that wealthy people don't necessarily spend less money than everyone else. They just spend it in a completely different sequence.
Exactly.
They prioritize increasing their ownership first. They buy assets before they buy luxuries.
We can call this the asset-first lifestyle. When a financially sophisticated person acquires extra capital, their immediate instinct isn't to upgrade their lifestyle.
Right, they aren't running out to buy a Rolex.
No, they don't immediately run out to buy a luxury car or finance a larger house. Their first instinct is to acquire another productive asset. They allow that new investment to compound, and eventually, the yield or the cash flow generated by that asset pays for the luxury.
It's a totally different way of navigating the world. One person is perpetually trading their finite time and physical labor directly for money to buy consumer goods,
Yep.
while the other person is methodically building a silent army of assets that works alongside them, generating the income to pay for their lifestyle in the background.
And over time, the gap between those two approaches becomes insurmountable. One creates a cycle of constant mandatory labor just to maintain a baseline lifestyle. The other creates a cycle of accelerating freedom where the assets eventually cover the living expenses entirely.
So what does this all mean? Should we all just log off, march down to our local bank branch, withdraw every single penny we have, close our checking accounts, and throw it all into an S&P 500 index fund or a duplex?
Definitely not.
Because after spending this entire deep dive explaining why hoarding cash is a guaranteed way to lose purchasing power, we really have to clarify a very important nuance from the text.
We absolutely do. We need to defend the bank. The lesson here is not that banking institutions are useless or that holding cash is inherently evil.
Right.
Cash serves an absolutely critical, fundamental purpose in any robust financial strategy.
This source material is quite explicit about this, too.
Yep.
Wealthy people do hold cash, but they hold it with specific intent. They maintain emergency reserves to cover unexpected personal shocks, like medical bills or sudden job loss. And crucially, they maintain liquidity to capitalize on future opportunities.
Yes, that is key.
If the market experiences a severe dislocation and high-quality assets suddenly go on sale at a massive discount, you need liquid cash to act on those opportunities.
This raises an important question for you, the listener. Regarding the division of labor within your own portfolio, banks protect your short-term savings from market volatility.
Yeah.
They provide the immediate liquidity you need to survive, and they facilitate your everyday transactions. I mean, you cannot easily buy your morning coffee or pay your electric bill with a fraction of a commercial real estate property.
Good luck trying that at the local cafe.
Right. The fundamental rule is this. Cash provides flexibility. Assets create growth. You require both to function effectively.
Cash is your armor today, but ownership is what builds your tomorrow. True wealth is measured by the number of productive assets you have quietly generating value in the background, not by the raw static size of your checking account.
Taking that into account, the next time you log into your bank account, try to look at that balance through a new lens. Stop asking how much you have hoarded away and start asking how much of your total net worth is actively deployed and working for you right now.
It's a complete paradigm shift, moving from a saving mindset, which feels emotionally safe but is mathematically vulnerable over the long run, to an ownership mindset, where you are actively acquiring pieces of the productive economy.
It really is the shift that changes everything.
We want to thank you so much for joining us on this deep dive into the alchemy of assets and the hidden mechanics of wealth.
It has been a pleasure analyzing these concepts with you. Recognizing the true utility of cash is genuinely the first major step toward long-term financial autonomy.
But before we go, we want to leave you with one final thought to mull over, something that builds on everything we've explored today. If cash is ultimately just a temporary parking place, and assets are the real engines of growth, what happens to a society where the vast majority of people are structurally forced to keep all their money in the parking lot just to survive, while only a select few are ever handed the keys to the engines? Keep exploring, keep asking great questions, and we'll catch you on the next deep dive.